Hello, ladies and gentlemen, and welcome back. 5 days is all it takes sometimes to make big decisions for the year ahead in markets. And that's what we've just had, the first 5 trading days. What does it mean for the rest of 2023? We'll be talking about that in today's video, along with equity risk premium, something that not many people have discussed in 2022. But if you're a believer that a recession is going to be called this year, it's something you will need to be paying attention to us. Join us as we cover stocks, commodities, and cryptos. Well, welcome back, everybody, to The Daily Show. We've got the lead news, the big macro data, and of course, the key levels coming up throughout today's session. We'll be covering all of those things and more, but let's begin with what happened over the last 24 hours. Of course, markets rallied massively. They went up to around 39.50, some stocks making as much as 6 or even 7% through the session, and then it all came crashing back down. Unfortunately, the rally was stopped. The end of the session was basically neutral on things like the S&P 500, but it was all thoughtfully because supposedly the Fed said they're going to be holding rates for longer above 5%. I don't really believe this is the real narrative. However, it's being used as the excuse to push it down. More on that a little bit later. But on to the main 2 topics of today's video. First up, Morgan Stanley's Mike Wilson warns US stocks could slump another 22% if recession arrives in 2023. Now, we're a pretty big believer that a recession is going to be called. I'm sure most of you out there believe that's going to happen as well. And whether it's mild or it's a little bit more sinister, we don't know yet. If you take a look over on our Twitter, follow at FX Evolution, links in the description down below. We posted here the expectation of Wilson in terms of what he thinks is the worst case scenario for the S&P 500 for, of course, 2023. And shockingly, it's actually 3,000. So it's even lower than the 32 kind of 50 major supports. But there are key reasons why 3,000 may be a great level. And of course, a lot of you out there would say, well, I'm going to load up the truck if that happens. Remember this. So many people said they were going to load up the truck with Bitcoin at 20,000, at 30,000, at 40,000 when it was 60 or even higher. This is why you have to have a plan and stick with it so you're ready for those things. Now, for ahead this week, we also have a bunch of data. Remember, Fed Chair Powell's coming out 9 a.m. EST on Tuesday. Then we have the Thursday CPI numbers. And of course, we also have the big bank earnings coming forward. So make sure to be all over this news as it is going to move the market. But why does Wilson believe that the markets may not be pricing in everything yet? Well, it has to do with equity risk premium. And basically what equity risk premium is it refers to the excess return that investing in the stock market provides over the risk-free rate. Generally, the risk-free rate is considered like tips or treasury bills, inflation protected. This excess return compensates investors for taking on the relatively higher risk of equity investing. And of course, the size of this premium varies and depends on the level of risk in a particular portfolio. It also changes over time. So basically what Wilson's saying here is that he believes that ERP always rises material when a recession arrives. And why not? Look at these 3 data points that we have here. ERP absolutely went on massive increases during these periods. Now, if you have a look at the time of this recording where our ERPs are, they're not exactly high, are they? So they've got a bit of room to potentially go up. Now, this should put compression on, of course, the stock market. And it's like saying basically that maybe a recession isn't priced in according to at least this stat. Is this everything? Not really. So how do we go to the next steps? Well, we've talked about this on the channel for a while. One of the unique concepts that is probably the best indicator of recessions coming has to be percentage of yield curves inversion. A lot of people say the 2-year versus the 10-year, the 5-year versus the 10-year, the 3-month versus the 10-year. All of these ones are inversion kind of callers of recessions. However, really, it makes sense. 50% of all yield curve inversion. If we get something like that, which we did in 2022, it's never been wrong since the 1970s at calling recessions before they happen. Now, it doesn't mean it happens the next day, but it does mean it generally happens in the next 6 to 18 months. And guess what? We're about 6 months on from this number now. So we're leading into that timing where we should be getting an official recession called. It's not been wrong. It's hit over 50%. and it's a very good indicator that that's what's happening this year. At least it's one of my leading ones that I use, and I think it's pretty good. So does this bring us to, oh, we have to be freaking out about the market? Well, most people are starting to agree that maybe Q1, Q2 could be kangaroo style. That is, we may see some extreme moves throughout the first 6 months of 2023. But history would also state that if you have a brutal year, such as a 20% down year, a lot of the time you end up having a decent next year. Now, how could that work? Well, what if we declined through the first 6 months of this year through kangaroo styling, and then by the end of the year began an epic rally? Remember, the year after midterm election years does tend to be much better in markets. Just before we go any further into today and why this could actually happen and both scenarios could happen, I just want to let everybody know that we're doing a 2023 giveaway. Make sure to think about entering. The competition links are down below. It's completely free to enter, and you've got nothing to lose. Basically, you get access to potentially one of 4 prizes. We'll be doing the draw next week on the 17th of January on one of our shows. And remember, the first prize is literally having a chat with me during our group mentoring, and more importantly, learning some of the systems that we use and how to incorporate them in your trading and investing journey. So let's move over to how we could see a bearish market, potentially the equity risk premium model being something that is something to look at here in markets. And we will follow that through 2023. So make sure to subscribe. And then also having a positive year. Well, they say the first 5 trading days of a year could bode well for 2023 or could bode well for any year. In fact, when you have over a 1.5% or over a 1% gain over those 5 days, 86.7% of the time, the market ends positive. And funnily enough, it ends significantly positive, 15.4%. It's actually the strongest statistical evidence that you have over these periods. So it's a very, very big number. And the first 5 days tend to lead into better returns. Look what happens when you have a bad 5 days. It goes to a coin flip. So remember this stat and always bring this into your analysis throughout the year. The first 5 days actually has a pretty big epic, or almost an epic style movement onto the rest of the 2023 or whatever year you're in. So let's talk about markets right here, right now. What are we seeing on the ground? Well, we had a huge rally, and of course, we've been looking at this dumb money versus smart money inflow and noticing that dumb money has been outpacing smart money again. Now, this was one of our best 2022 indicators, and we loved the crosses. So whenever we saw dumb money crossing smart money, we had a feeling that we were at specific highs. We've seen that cross again, and we're where we are now, ahead of CPI numbers. So there's a lot to discuss in the charts when we get onto those a little bit later on. Let's move over to the money flow here. What's been going on in recent subsequent days? So something we talked about in pretty much the last 2 videos was there was an interesting rotation occurring. Some of the most or the best sectors during December, which were utilities, staples, energy, and healthcare, were not doing so well anymore. In fact, they were getting rotated out of, while we saw semiconductors, communications, and consumer discretionary coming back in. These were absolutely the most hit sectors over the last month. And we saw that rotation over the last 5 days. Now, what happened in the rally over the last 24 hours is no real surprise. One of the leads was semiconductors. Semiconductors did really well. Consumer discretionary did really well. And at one point, some of these sectors were up almost 5% on the day, the entire sector. So it was a huge rally, probably a little bit carried away. And then, of course, when we got that note from one of the Federal Reserve members, all of a sudden the market just absolutely dumped. Now, was it that reason, or was it more likely options? I would probably say it was to do with the options expiration ahead of this inflation number, and of course ahead of Jerome Powell's speech. Basically, we're in a kangaroo style market where it's going to jump up and down. We do still have some lead theories about key levels that we're looking for, but maybe we spike them during the news events. And I think that's something that we'll all be looking at together. This is going to be a tough week because it is highly, highly volatile. What else are we talking about for 2023? Well, of course, if that equity risk premium becomes true and we end up not having a priced in market with enough fear in it, then all of a sudden we could be looking at forward PE ratios being something that we want to look at away from the median. We know that around 17 is fair value. That's the current price of the market as well in terms of forward projections. What we'd love to see is some of these low levels, 14, 15, 10. Imagine if you get some of those. During 2020, we got a 13.3. So during times of fear, remember, forward projection PE ratios can be one of the reasons that you potentially think, hey, the market's cheap, buy some form of deviation from the norm. And that's what's always about. When markets are expensive and they're too expensive compared to the normal, that's when you start to say, well, maybe I want to reduce my purchasing. But once they're cheaper, maybe you want to increase it. Of course, make your own decisions, but it's something that I think a lot of people should be looking at. One of the indicators we used a little while ago to detail that markets may be going down over the next couple of months was, of course, our MACD one. MACD with the 200-day moving average. When we saw those stats, and this was about a month ago, it really helped us to define that markets could be quite weak for the next little bit of period of time. And in fact, could be even weak upwards of 6 months. These are not good statistics for the markets. 25% of the time, they're bullish after this number after 3 months, and only 40% of the time after 6 months. That's not a very good signal. And of course, when you get these signals, as you may notice, they happened in both 2008 and in 2001. So we got those signals during recessionary periods. We've had them again. If we are seeing a recession, highly likely, will this continue to make sense and come through? The way we get there is going to be the fun part. And that's why a lot of you watch this channel, because it's going to go up and down and all around. But at this stage, this bearish overtone is still there. So it's going to be a very interesting next couple of months. Let's move over to earnings. As we know, this week is Citi, Wells Fargo, and of course, Bank of America, JP Morgan as well, coming out. It looks like with their big announcements, this is going to be the beginning kickoff of earnings season. Of course, banks are important. They're going to detail whether the economy is super sick or not. And then we move into some of the big guns, Tesla, Netflix, and of course, followed up pretty much in early February by the big ones, the big tech, and that's going to be highly volatile periods. Let's take a look at the VIX. We expect the VIX to have an interesting first quarter. We'll do some analysis on that moving forward. Traditionally, the first quarter is where the VIX starts to go a little bit nuts and does go up. It's sitting at 22 at the moment, and we would hope to see a VIX a little bit higher than this over the next quarter. Now, we have always talked about this same thing, so I'm not going to mention it too much, but remember that we are looking for a VIX ideally over a 45 plus reading at some point during 2023, because usually during bear markets, you get a capitulation. Something like a 45 plus VIX reading tends to lead into that type of thing. So remember, the VIX is a fear indicator, though it may be becoming a little bit more useless than some people would like to admit. And we'll talk about that again when we do our VIX deep dive. JP10Y, we're watching this. This is the Japanese 10-year bonds yields. Nothing happening here at the moment. Remember, they've got it pegged at 0.5, basically meaning that it shouldn't rise above that. Have it on your charts in 23. At this point, we haven't seen it spike again, but we'll be watching it. We'll come back to it later. US 2-year. Not too much movement here. It actually went down through the session. So interestingly, even though Federal Reserve members came out and said hawkish things, we didn't really see too much yield movement. 4.83 on the April. So we expect to have basically the top in probably from the Federal Reserve terminal rate somewhere around March, April of this year. And then we just kind of looking at maintaining that rate for quite some time. Basically, the Fed said in their dot plot the other day that they weren't going to cut rates for 2023 at all. Now, the market doesn't believe that. We'll find out what's true. But at the moment, the Federal Reserve have said we're not changing the rates once we get to our level. And their expectation, remember, from the dot plot was 5.1%. So I don't think there's really any changes to the market. Again, it's not new news. It's just an excuse to probably suck people in, and then we'll find out the next move, I'm sure, after Jerome Powell's speech, 9 a.m. on Tuesday. Let's move over to high yields. High yield bonds are increasing. Now, I have said this. It's been one of the best indicators of 22. Don't get me wrong. And it is buying at this stage. Now, a lot of people are going to use this and say, well, high yields are going up. I'm going to buy the stock market. I think we've come to a disconnection now where the bonds market is actually more attractive than it ever has been for a very long time. Now, I don't like high yield bonds. I like things like TLT, treasuries, high grade corps, that type of thing. But we did still see a gain over the last 24 hours. Most of that can probably be attributed to some of the things like the US 2-year and 10-year actually declining, but high yields were still up. If we take a look at TLT as well, treasuries, they were up through the session. And if we look at high grade corporates, they were up through the session. So it's not all horrible, but I don't know whether they're connected as much. And we'll have to do some deep diving on that to see whether they've started to disconnect. Because my belief is they have, and that actually corporate grade bonds and TLT and treasuries are some of the best. Remember that equity risk premium. They use TIPS a lot. They use equity risk free premium basically was always around. Okay, bonds and things like treasuries were kind of like risk free is what there was assumption. Now we know that's not true, but it's interesting to see this massive difference. And a lot of bond managers I've been talking to like corporate grade bonds more than they've ever liked them for a very, very long time. So it's certainly one of those points. What about the DXY? What's happening there? Well, it dropped to a new low, and I've got a trend line here that I thought I'd bring up. This is one that's come pretty much from the lows all the way back over in 2021. And you can see it was a big point in 2022 as well. We just hit that. So have we rejected from that? Not really. We haven't made enough ground yet, but certainly some interesting points. And I've got a little alert above 103.55. Most people are trying to buy the US dollar at the moment. There's a lot of retail traders that have been trying to buy it all the way through this non-farm payroll drop. I wouldn't really feel very confident in it until it breaks that 103.50. Then I'd be looking for a pullback and maybe through. This could be a false break to the break low. But at this stage, guess what? The trend's down. Yes, it's into the trend line. But unless you're a scalper or a day trader, for a swing trader, they're not going to be in this saying, oh, I think it's going long here. It's a very, very tough area to prove just yet. We will follow along with it as much as we can. Let's move over to gold. Gold hit a critical level. I notice everyone's talking about it now. We've discussed gold for quite some time, specifically when we saw those weekly rejections down here, and of course that basing. Now everyone's on the gold bandwagon. Everybody thinks it's the greatest asset ever again, and guess what? It's hitting those critical resistance levels. So has it ended? Well, we don't know that yet. We haven't seen a switch of trend. But what we can say is that everybody is now talking about it. So that usually marks that the easy money has been made towards the long side, and now it can go into more of a consolidatory kind of run. If the news media is all over it, usually that means that we're getting close to a consolidation period. You can see here that it's starting to consolidate. It's made no new lows, though, under considerable levels. So we're basically just trapped in a zone for now. We'll continue to follow it, but yeah, that's where we're at. What about US oil? Well, US oil almost got back to the level we wished. 77 was our target for a short because we had that drop and then the little base, and then we were looking for a drop and then a pullback and drop. And it just didn't quite get there. It got to the bottom end of it, 76.70. Woof. Anyone get this short? I'll be interested to know. But yeah, not a bad one if you were day trading it and you're prepared to take it a little bit early. The sign towards its weakness was probably around this particular candle side. So when it made that new low, rallied up and then dropped completely, and then of course rallied that final time. This was when you started to say, well, wait a second, looks like this was a false rally, pushing through more buys. And then of course it took all of those, rallied and moved back down. So yeah, oil, what happens now? If we look at it on the daily, that was a fairly decent rejection. It's probably not enough to say, oh yes, it's going to 65 yet, but our long-term, medium-term goals are still 65, 66 a barrel down in this area. I'd love to see some strong accumulation in here for a while for oil throughout 2023, and then maybe it will come back as a decent asset around that area. Let's move over to Tesla. Tesla here actually hit the top end of the band for the expected weekly options. It was a big move. At one point, Tesla was up very significantly through the session. And if we go down to the daily, you can see how wild this trade is. It's basically got big dumps, then followed by huge gap ups. And if you're thinking about getting into something like this, you've just got to be wary of probably the expected moves. I've updated what the market believes is going to be trapping price, which is 127 on the high end, which also happens to be a bit of a resistance, and then 112 on the low end. So the market expects that during this week, price will basically remain within these two boundaries, and we're sitting right in the middle of those boundaries at the moment. So imagine if we come back down to 114, 112. Guess what? We've got that previous little bit of resistance that could become support. And at the same time, we've got those gap closures. So we've got gap closures coming in around here. Interesting point, certainly for the market. I do like this day. So this day gave me a bit more confidence that maybe Tesla has found base. And the reason is purely simple. At $100, there are too many puts. We know they're there for quite some time. We've looked at them before. Let's have a quick look again. The 20th, you can see the 100 puts. Let's have a look at the 13th, which is this week. We'll load that up. You can see max pains around 116. And if we just refresh this to make sure we've got the right price, there you go, 115 now. Again, you can see those 100 puts. So the 100 puts are very unlikely to make any money. The 190 guys, they're not going to make any money either. And basically, somewhere in this area here is where you expect the market to start to consolidate. So you've got those kind of top-end options boundaries, which sit in here. And it makes sense that if they hit, you would think it goes down, just like if it hits here, you would think it goes up. Two key levels for Tesla on the markets. Let's move over to Apple. Updated expectations for the week is basically still the 134 and the 125. Pretty wide. It did fill the gap, or got close to filling the gap after a nice rally through and then dumped off. Didn't quite hit the top end of our expectations here. But Apple's another one where if you look at it on a weekly, it's a very interesting chart because you had a rejection wick showing that demand is here for the stock. Then in the last 24 hours, you get this big daily style rejection, which looks like a shooting star. You can't really like these candles. Yeah, this is where the conundrum comes in. We'll talk about a few stocks now as we go through them. Amazon, this was a beautiful looking setup through the Friday. I said this on the live stream. I love this spring trade that takes the stop losses and then rallies. It was a great session trade. It was a great pickup if you had it on Friday. And then all of a sudden we get that hanging man that kind of just dumps down. So today's movement is going to be pretty important because when you think about it, this market has basically gapped up. If we gap lower, let's say we gap low and we start opening, that's kind of like a reversal signal. And then all of a sudden you'd expect a bit more of reversing, possibly back down to these zones. So the open is going to be pretty important for stocks like Amazon. If it gaps low, technically that's like an island reversal. Although they're only small statistical advantage, that's still a key level, and that's what it would be. A gap low would be an island reversal. If we take a look at the 30 minutes, again, gap up. If we get a gap low, could be a very interesting chart. So certainly one to watch at this point. We'll find out what happens with Jerome and, of course, the speech. XLY versus XLP. I do think the market's been rotating into consumer discretionary recently and out of staples, which are high. You can see that the market is starting to purchase these. This is the first activity that we've had in consumer discretionary for quite some time. And there's the weekly two closes. Bit of wicks, a little bit of purchasing. And again, just showing you that the rotation doesn't seem to be like all staples are fantastic. It's been consumer discretionary has been a little bit better recently. It has just hit the trend line on the way down. So expect the next 24 hours to be very important for this one in particular. We'll revisit it in the next video. DAX here. DAX is at a critical resistance ahead of the news. We'll find out what happens. Rejects that 14,800. Anywhere between 14,000 and 15,000 is pretty important. So we'll see what ends up happening there. It's just that resistance. There's not much you can say. And it doesn't matter which US market you look at, all of them now have these potential false breakout type signals. Here's the Russell 2000 one. Here's the one for the US 100. So the Nasdaq, and of course the Dow also has a little bit of rejection. And we take a look at that on the daily. There it is, another shooting star style candle. So traditionally, when you look at these, it looks like this is kind of could have been accumulation. This was a rally that was super epic. I mean, it definitely was running and running and running, unbelievably running. Then it dumps it, and the next couple of sessions will be really important. If the market does end up making a close underneath, that's going to be potential bedlam because basically that convinces, or that really says that this was distribution, that was a false break, and now we move down. So a pretty big move, or pretty big area for the markets for sure. Actually, we'll go back over to the US 100 just to show the counter here. Again, it comes up and taps into this area. It didn't quite set alerts off that we had up here, but we will set an alert now for 13,000 or 11,320-ish, just to see whether the market can break through that level. If it does, we have this expectation that, of course, further rallies could ensue. And if the market does end up making a new low under here, don't be trying to pick the bottom, because again, that would prove this is distribution, this is a false break, and all of a sudden potential capitulation. And a lot of you would probably like that. I find it hard to believe capitulation can happen before the 20th of January, and the main reason is options, which we'll look at in a second. But let's check out the current move expectations for the SPY. We've still got the expected options weekly high at 396, which is pretty much where the gap fill is. The low is 379, that 380 heavy support level that a lot of people have been buying off. And you can see the rejection here. SPX, so the real market, let's take a look at that. 38.92 is the current closure level. We did want it up here. I don't know if I'll change that yet. So 39.95, super key level. And yeah, this is going to be a really, really tough week now that we've seen this candle, because if you're looking at it, you're going to say bearish. It's going to be tough to even think bullish. If the market then comes through and grabs this area and then rejects again, it's going to be brutal on the markets after that, similar to what happened over here. So let's take a look at the futures market and see what we've got so far. So what we don't want, well, if you're a bull, you don't want that. Basically, you don't want it to do this. If that happens, watch out down below. Very likely it's going to move much, much lower. 39.95 has been one of our critical levels, and there's a lot of reasons why we really like that. We got close, but we didn't get to it. 39.51 was pretty much where we got to. So the reason we like that level so much is it's quite a few reasons, actually. It's the golden fib pocket, so 61.8 fib. We've got the downward trend line. We've got the unfilled gap, a daily close level, and of course, we've got some moving averages sitting on it. But this was looking like accumulation. It boosted up, it rallied through, and it failed to close above. So at this point, you have absolutely no close above. So we have to now look at the really small time frames to figure out what might be happening next. And when you look at the small time frames, which we can do here, you'll notice it broke lows of these areas. So it went rally, 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 dump, 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 dump. Now, if it rallies somewhere in this area and here, between that 39.20, 39.30 zone, is going to be a tough point for the markets, because if the rally comes through with the information that we've seen so far, you would think bears would be there. Now, if the bears then pressure a new low, so let's say we sit around here into the open, rally up, sell off this area and press a new low, you've got to think 37.50 is probably coming at that stage. So that's going to be important. Now, if we get a new high, of course, then we go to 4,000. So yeah, I think it's going to be a very, very tough time. Jerome Powell may move the markets. I'm leading into kangaroo, most likely into the inflation numbers. The inflation numbers will no doubt spike markets very heavily. The implied volatility, the options, everything is becoming incredibly volatile for the rest of this week. And then, of course, we start off those earnings. So it's a very, very tough time to correctly predict every single move. You're going to have to be very nimble and fast, and probably more day trading and scalping. We do still like the 39.95. I'm not going to say I don't like that level. I'd like to see it hit and then see the reaction off that. A lot of the time I say patience, react, don't predict. And the main reason is because if it comes to your key levels and then you see your normal, let's say, purchase or sell kind of setup inside of that area, it gives you greater confluence and greater confidence in that trade. So that's something I really like to do. And I'd still love to see that 39.95 come through. So what about the options moving forward? Well, let's have a look at the S&P 500 for the Friday. 385, current stock price 387. You'll notice there's not really a significant amount of options through this week. It's pretty thin, which is surprising. But the big one is going to be the 20th. This is the third week options expiration, almost 5 million units and still a max pain of 390. So if the market starts to move down too much, sits on like a 375 or a 380, then you've got to expect that some rallies may ensue past that point. If we end up getting towards, let's say, a 4K before CPI, then there's a lot of room downwards before you start hitting some of these critical levels for the 20th. So there's a lot to talk about as we move through this news. I expect kangaroo-style markets, and it's not going to be that easy to navigate on the medium to longer terms. Let's have a look at Bitcoin, see what's going on there. Bitcoin had a nice rally, hit 17.4, which is the bottom of our box, and then sold off. If the stock market can continue to rally and find new buyers over the next 24 hours, you've got to expect Bitcoin to remain potentially bullish to 17.5, 17.6, which is our first kind of target zone box. And Ethereum also is having a little bit of a breakout on it as well. It's not quite through the key levels, but we've got that 13,000 kind of 60, well, it's really 1,350, 1360 zone, that if that breaks out, there's a little bit of room to give for Ethereum. So it is forming a little bit of base here on the 2 hour. You can see on the daily as well, the way it started to curve. And it looks okay if it breaches these wicks. Remember, the wicks hold the orders. So if we do get above that, all of a sudden we're saying breakout. And you know what happens with crypto breakouts. They often go fairly quickly. So interesting zones depending on what the Fed says. And obviously the market participants want to push it in. Let's move forward to the news. Tuesday, Fed Chair Powell speaking at 9 a.m. Eastern, so that's New York time. Then we have the big Thursday one, which is going to be a big one. Now, interestingly, they've got FOMC member Harker speaking at 7:30 a.m. Usually wouldn't move the markets, but you never know. And then 8:30 a.m. is the big one. I would say this is to cover this number. So probably something to cover here, which is usually what they do. 8:30 a.m. though, it's CPI. Don't worry about the year on year too much. You're looking at the real number. You want to know whether it's up or down and what's increasing, what isn't. Stagflation, is it in rents? Is it going to be in food? These are all discussion points we'll talk about. Then on Friday, we've got, of course, the big earnings reports coming out from the banks and prelim UOM consumer sentiment. This week is massive. I cannot overstate it enough. This is a big week. Big inflation number, the biggest bit of information coming out. Then we start off and kick off earnings season. And of course, we've got the Fed coming through trying to battle whatever type of thing they want to say. But I don't believe really that the market moved just because the hawkish statement. It was most likely to do with options and the fact that they sucked in a lot of calls over that period. We'll have to see what happens next. Good luck out there, everybody. Subscribe, smash that like button. We'll see you in the next one. Bye for now.